Over to you.
Thanks, Andrew. So while we're having the guys mic up, I just thought I'd take a couple of minutes to introduce you guys to a research report the CFA Institute produced late last year. It sort of formed the basis of the session we're trying to do today. It's called Fun and Games, or Gamification, Fun and Games in Investment Markets. It's looking at the use of behavioural finance techniques in online investment platforms. We have representatives of 2 online platforms here today. I have some questions that may lead them down the route of talking about gamification. You guys have access to Slido, so ask the questions if you'd like. But essentially, this report and the webinar that accompany it is available online. All these slides that we're presenting today will be available online. On my slide, that URL, you can just click the link and it'll take you to the page. It's fascinating. It's really, really interesting sort of stuff. While AI is interesting, behavioural finance can directly influence outcomes for you without you even knowing it. So I think it's a really interesting tool. The CFA report, anyway, came up with a couple of recommendations. I've just summarised them here. You guys can read, I can read. When you take the slide away, have a read and a think about this. My takeaway from listening to the webinar, and some of you may have listened to it when it was broadcast, was that it can be a tool for good. It can encourage increased investor understanding, investor knowledge, but there's not a lot of evidence to support that actually happening. There's not a lot of evidence to support worse outcomes happening, but there is evidence that suggests that online platforms increase trading frequency. There's a shorter time to decision making than there are if you're on a computer. So you can see the output, and when I spoke to the researcher about it, he said, we have plenty of anecdotal evidence to support the fact that behavioural nudges in platforms are getting not necessarily great outcomes. I'm going to get Anthony and Leighton today to talk directly to some of those concepts, how actually that might not be the case in the New Zealand market. We've got Paul Gregory from the FMA, and these guys can introduce themselves, who will give the regulator's perspective on this today too. Each panellist has some slides to talk through. I said 7 minutes initially, I cut it to 5 minutes. These guys know how to talk. So we'll give them some
it's about me,
leeway. It's about you, Anthony. It's always about you, Anthony. So what I'd encourage you guys to do in the audience is put questions on Slido, because I'll see them. And without further ado, I'll get Anthony to go first with his slide deck.
Cool.
Thanks.
Thanks, Alister.
Get my phone. Thank you.
Yeah, as Alister said, I'm Anthony Edmonds. I'm the Managing Director of Implemented Investment Solutions, but also InvestNow as well. So, yeah, it's a fantastic opportunity to talk to you today. Certainly for Leighton and I, pretty proud day for our mothers when a boy from Opunaki and one from Wanganui gets to present to such a prestigious group of investment professionals. We probably won't tell our parents that they sent along the head of enforcement from the FMA to sit alongside us just to make sure we stay in line. In terms of InvestNow, just to give you a quick little bit of background about it. InvestNow, it's obviously an online investment platform. We've got a whole range of managed funds, ETFs, term deposits from 6 different banks. One of the big pluses about a platform like this is you only have to do your AML once, and correctly, Paul, and you can buy a whole range of different providers' products in one place. We've also got a KiwiSaver scheme. The key point and difference in that is you can get multiple different providers' funds all in one platform, so you can invest in Milford and Pathfinder and Harbour all at once rather than having to join just an individual scheme. Currently we've got about 25,000 members, about $1.4 billion of assets. We've only got 6.5 staff, so we're pretty efficient in terms of running the platform. Average portfolio size is around $55,000. It's a real 80-20 rule though, that we've got a cohort of significant investors inside there. We always talk about we're a platform for serious investors. there we're not talking about people with propellers on their hats and things. We're talking about people who actually, investing a serious amount of money and want to get it right and do the right thing by themselves. I guess in terms of the rise of the platforms, the things I'd observe is they're pretty lightly regulated. Certainly the difference between running this and our MIS licensed business is significant. COVID was just a godsend for us. Things were good before COVID, Leighton. COVID saw online gambling stop and everyone wanted to join investment platforms and starting to invest, so it was certainly a godsend. For me, I really enjoyed watching The Social Dilemma. I actually watched that and I thought about Leighton and Brooke and their business and went, wow, this is amazing, because in these platforms you've got amazing data of what people do. I think a real key point in that, though, as all of you know, in terms of studying things like behavioural finance, people are inherently flawed when it comes to making investment decisions. They do all those good things of anchoring, thinking, being overconfident and making mistakes around that. And so people have to be pretty careful. And for us, we're always trying to tie people back to key principles. ChatGPT, we asked it about key investment principles, and amazingly it pretty much named the same 10 as us. And so ours are pretty steak and eggs in terms of it. On the next slide, I just put up a whole lot of different things that we think about, whether they be those principles like having a plan, diversifying, not getting distracted by market volatility. We think it's really important that people stick to the basics and do that stuff right. I don't think it's that hard for people to invest. There's lots of resources out there that you can sit down, look at your risk profile, get all the real fundamental things that drive your return right. You can look at things like diversified funds to understand how professionals invest. I'd highlight that your average growth KiwiSaver fund's got somewhere like 1,000 securities in it. It's a pretty good guide for how diversified you'd want to be, 6 different asset classes, all of those good things. I think people need to really look at that and understand it. There's stuff in there like, again, linking to those principles. I know, Leighton, you guys had an ad once which showed 2 people having a kiss, and the whole thing was, give it a go and get started. In my little slide there, I've got a picture of 600 kids at a school saying you'd want to kiss all 600 of them in an investing analogy, because it's really important that you're diversified. Einstein said compounding's, whatever it was, the 8th wonder of the world. I'd highlight that when you lose like 70% of your money, you've got to make 400%. And so that certainly was a learning for me that I hadn't seen in the textbook when I was a kid. And so I think, buy the dip and hold are great in a diversified portfolio, but super dangerous if you're holding an undiversified portfolio of single assets. Some points that we'll probably cover off in questions in terms of the Wild West, but I'll leave that into the Q&A part.
Right.
Cool.
Sweet. My turn. Cool. Thank you. Kia ora koutou katoa, ko Leighton tukuingoa. Leighton, co-founder and co-CEO at Sharesies. A topic and a study actually pretty close to our hearts, and a few things I'll touch on first. So it's important, the purpose of Sharesies is to create financial empowerment for everyone, and I'll come back to that in a second, why it's so relevant today, with a vision to give someone with $5 and $5 million the same money opportunities. So Sharesies at the moment, we offer invest, so about 10,000 products across US, Australia and New Zealand exchanges. We have customers, starting with $10 and teaching a kid right through to sort of cap out around, at the moment, around the $5 to $6 million portfolio. And we also have just received our KiwiSaver license and exemptions to bring a new type of KiwiSaver to New Zealand. We work very closely with companies on partnerships, and we also have a Save product, which has become very strongly requested in a new interest rate environment that Sharesies hasn't spent a lot of time in. Just about some numbers on the business. So 67% of our customers are aged under 40. We've got about 560,000 customers across New Zealand and Australia, 260,000 of those active in the last month. And obviously that changes, but very high level of engagement from the customers, and average portfolio size at the moment of 4K, and like I say, huge range around that, and a curve on the age range that skews with a median around 35, but very long right out to people over 100, and people just a few days old, basically. As soon as you can have an IRD number, you can get a Sharesies account. Anyway, up until very recently, the VIX had been a pretty epic leading indicator of any volume that would come through the platform. And in fact, last time I presented at something that related to the CFA, this is what I was talking about, and it was around the March 2020 time that we all remember, and saw a very large rush of investors at that time. Then GameStop came along and sort of blew that out of the water, and the reason why I brought it back to the purpose, GameStop, when you looked at this, the blue being the number of customers that Sharesies onboards at any given time, versus the market and where it's going, or the VIX, and you know, we're almost seeing our business, or what's been asked for overnight. So we've got this fundamental purpose, which is to create financial empowerment for everyone. On the other side, our customer and our customer care and everything has been dominated by this meme stock thing that's happening on Reddit. And whilst it's very nice to see lots of customers onboarding, what you don't want is your investor care profile changing completely, the whole idea of your business and what you're trying to do. So we really had to lean into this as a big problem, because it's not what we're working towards, and we're very proud to be a purpose and profit company. And for that, it's important that your commercials align very closely to the outcomes for your customers, and meme stocks weren't that for us. So a few other large news points, but a big thing of behavioral economics is news drives people, particularly when you're talking this large mass market as we. And between 7 and 8% of our investors traded in at least one meme stock, which at the time was tens of thousands of people. A massive number, and you know, a few thousand of those, we were sort of onboarding about 1,000 customers a day, which is an increase of about 30% at the time. We're onboarding just for this phenomenon of GameStop. So there's a couple of things there of how we reacted to it, which is a huge amount of education going out there, but also tools within the app, which might be referred to in the report as nudging or gamification and things, to really bring this to people's minds and try to change the way they're behaving on it, particularly around these products. You know, GameStop, I'm not sure if anyone had even bought the thing on Sharesies before it happened on Reddit, and all of a sudden it's your most purchased stock, albeit in reasonably large, small numbers on average. If we fast forward now, that same customer base, if we look at them, their stock breakdown looks more like this, with Australia, 1 Australian stock, 4 New Zealand stocks, and 5 US stocks. Most fascinating about this for me is 25% of the FUM on the platform is funds, or ETFs, or managed funds. For this particular cohort of those who bought meme stocks, it's actually now 25% in ETFs and 5% in funds. So that tells me that all the education we've done, the work towards nudging them and stuff, has worked, and we've got some way to go to that. And if anything, actually, it tells me, are we doing enough on the rest of the customer base with regards to this space, and what are the triggers that are going to do that? Just another stat that I like, people always like to raise the risk for Sharesies from a sort of institutional perspective that always is raised to us is what happens in a prolonged downturn. And we had March 2020, it all happened very fast, we had people rush in, and it was sort of like, well, that shock doesn't count. But now I think it's fair to say that the customer base has seen one, and the blue line there against the market represents withdrawals on the platform, and it's literally flatlined. With the introduction of our Save product, which is only a couple of weeks old and currently only in the hands of 50,000 customers, our withdrawals have so far decreased by about 25% through that period as well. So it's just super interesting how much education is working on this customer base. Another stat I like to show is most of Sharesies customers dollar cost averages and use auto invest. So this graph here just showing the difference between Sharesies customers versus retail across the exchanges broadly, and showing that we're still long in the market, we're still doing the same number of buy orders actually, and people seem to be behaving rationally, or as we'd like to have it. Anyway, the platform's constantly changing. I just want to put this one up there. Gamification includes, you should include pricing when you bring this in. It's a huge part of how games are used these days, and we've recently changed our pricing to a plan model, and the impact of that has been a far higher number of auto investors. So far it's increased by about 15%, which for us is exactly what we want to be seeing. Anyway, I won't go into this, we're about to talk about it. Future of finance, in our view, is confidence, and that's where the AI part turns in. Extremely fascinated by this, slightly terrified. I personally think it is going to be a night and day moment, is my view. I think we're about to see the biggest change to the way people work, the way people think, the way people live that we've ever seen, and I expect that to happen over the next 5 years. And the next one's being control and connection, and how we can bring people closer to that and make better decisions. So look forward to some questions soon. Paul.
Tēnā koutou all, and good afternoon. I'm going to take obviously the regulatory perspective on gamification and talk first about the regulatory framework which applies to it, and also we'll focus more on gamification and what our framework and our approach to our regulatory role would shape about how we think about and engage with gamification and with the providers who are using it. So the CFA Institute research paper prompting the session draws links between gamification and marketing and advertising, which is why wherever our fair dealing powers apply, and it doesn't apply everywhere, it will be one of our key tools for deciding, for dealing with gamification where it presents. And you can see there that the regulatory framework that the FMA and indeed market participants operate under is many layered. And it has many layers, and we have many tools that we can apply to each layer. And what parts of that framework apply to the risk arising from gamification depends almost entirely on what package it comes in, what provider is using gamification, the entity type, the market that they're operating in, the business model that they have. And what we've done there is just showed how different sorts of provider touch on different parts of the framework. So we have an offshore provider who might be offering a product to New Zealanders from offshore which has gamification features in it. And what we can do can be as little as actually nothing. But there can also be consumer warnings. If they have to be on the FSPR, there could be a complaints body involved. Then there's something like the Sharesies platform where more of the regulatory framework applies. So fair dealing, which I've talked about, AML CFT, client funds, market integrity, and of course, as a market participant with the NZX market participant rules. And then to Anthony's point, if you get to a managed investment scheme, it is everything from market integrity up to licensing conditions, best interests, duty of care, equitable treatment, and if advice is offered, advice legislation. So, as I say, it depends on the package, it depends on the business model, it depends on where the gamification is occurring, that depends what parts of the regulatory framework we can apply. Then there's an outcomes approach to gamification. The CFA work says that when used well, gamification can be a powerful tool for engagement, literacy, and positive outcomes. So if gamification features are inserted incompetently or with the intent to mislead within what is a quite complex decision-making process, it actually increases the information asymmetry between the investor and the provider because it positions as simple, or worse, makes simple, a choice that actually carries substantial risk and potentially substantial cost. So the reason why we talk about engagement and gamification is because any engagement efforts which increase the ability of the investor to make good decisions is positive as far as we're concerned. For example, in KiwiSaver in the default schemes, particularly when they were in their conservative settings. But not all engagement supports capability. There are sort of barriers to this, which include the reasonably innate behavioural barrier. It is actually just never easy to engage any customers on financial products. Research shows this again and again. There are technical reasons. The provider might simply be too focused on what they want to say and not enough on how the consumer wants to receive the information, and that can be an issue with the channel, it can be an issue with the language, it can even just be an issue with it being timely or not. And then of course there's conduct. Sometimes poorly informed decisions are commercially beneficial, so that's misconduct. Gamification for us has the same risks and potential harms as other forms of provider communication with investors and consumers, but again, it can be positive if it improves decision making, so for example, choosing suitable products. If it introduces a good decision over no decision, for example, contribute to KiwiSaver or not, and of course, if it's not misleading. How that translates then to something which is not just a compliance conversation is the sorts of questions that we would ask a provider, obviously depending on what part of the regulatory framework applies and what package that the gamification comes in, which is more open questions. Any particular application of gamification is part of a larger end-to-end system which is designed to produce one or more outcomes for investors and for the provider, and we have to get into the detail of that. We cannot look at the gamification, the algorithm, the code, whatever the killer application is, in isolation, because that doesn't tell us the impact, which is where we need to start. The research work, the CFA research work, talks about some applications of gamification using the least important features of games, badges and points, rather than the story, the information, and the experience. This, to us, is another way of explaining the delta between simply engaging and building capability. To a regulator, whether there is a story, information, and experience, and what that is a critical insight into product design and ultimately into the provider's incentive and their business model. And that's where conduct is made. So these are the sorts of questions that we would ask. What outcomes do your investors or consumers achieve from your use of gamification? What outcomes do you achieve from your use of gamification? Are they outcomes that you would not be able to achieve otherwise? Are the outcomes better in some way? In short, how does gamification contribute to those outcomes? And finally, what are the risks that come from your approach? And what hard and soft controls are in place? Thank you.
So thank you very much, the three of you. I think as we start, it's really important to have some context around the level, or to just thank Paul, Leighton and Anthony for being here, particularly Leighton and Anthony for the innovation that their businesses have brought to the industry. I have an InvestNow account, I have a Sharesies account, I've opened them to see the process to go through. I was a director of implemented investment solutions for a number of years as well. So I've seen both the effort that goes into creating these platforms, the blood, sweat and tears that are sweated by the staff, but equally the challenge they've thrown to our industry in enabling a new generation of investors to easily access broking capabilities and managed fund capabilities that was very difficult to do as a retail investor 10 years ago. So that's sort of the theme setting. We want to talk about innovation. We want to talk about some of the challenges that are thrown down to the industry. We want to then touch on gamification a little bit today as well and the regulatory environment for it. So to ask the first question, maybe to Leighton in this instance, what are the new opportunities? Where is your platform going? Where are platforms like yours going? What's the next step of innovation that you can bring to the market?
Yeah, there's two types of innovation or things we're thinking about with regards to next steps. One is things that we know and things that we're working on already. And that includes things like, bringing behavioural economics along the journey and supporting people in better decision making. For Sharesies specifically, that's introducing guardrails types features into supporting decision making. And the reason we've done that is because our research shows people on our customer base at the moment had a preference to tools to support them in better decisions over advice to support them in decisions, which is a super interesting insight and one that we'll sort of work on over time. With regards to the other part, the complex challenge for Sharesies at the moment, at a direct level, founder level, is absolutely AI and its impact. And I could talk about it all day, but there's some very interesting fundamental problems that AI creates alongside what's potentially a little bit easier to grasp, which is an absolutely gigantic opportunity in supporting people to make good decisions without risk. So we'll be focused on, continuing. I don't think democratisation is the right word anymore, but it's now, if we were to define our strategy as access, confidence and motivation, we sort of consider the access one to be done. If anyone comes to me with any financial product, I can probably tell you how we can distribute it for 1 cent or less. That's basically solved. The confidence and motivation are the complex bits, and we'll be working on those forever. That will be Sharesies' life strategic problem, basically. So thinking a lot about that with regards to moving forward.
About you, Anthony?
In terms of the future of where to invest now goes.
Yeah.
It's changed, Alister, in terms of now we've been purchased by Apex, which is a global investment business. We're looking at, okay, how does InvestNow sit inside sort of the global business of Apex? I'm pretty sure the instructions I've had from Peter Hughes, my boss, is to go and get it into 55 countries around the world. So far I've fooled him into thinking that Stewart Island and Chatham Islands are the first 2 that we've conquered. And I guess, yeah, I'm looking at a number of platforms, sort of in and around things like providing access to private equity funds, almost democratising private equity is quite an interesting area and something that I think we could play in at a sort of on a global scale.
So we had a session just on ChatGPT and AI, which I personally found absolutely fascinating. So thank you, speakers, for talking on that. Leighton, how do you see using this sort of technology in order to create more efficient and effective investment processes? How's it going to change your business?
Yeah, well, we're actually already using it in a couple of places. First place being internally at the moment, so within our just internal Slack, which is some Microsoft Teams thing for anyone who doesn't use that, but we have bots in there that support our investor care team on responding to customers, so effectively a language model that supports, and basically it's in a separate channel. An investor care person can ask the question of the bot, it can get an answer, and then it can, you can put a human overlay over it, and then we can send back the result. Something that is already a problem for AI is that once the human enters the equation, then sometimes we can add complexity or we can overly simplify it. Or, both of those 2 things are problems. And one thing we're discovering is that people then go and use ChatGPT or whatever it is to then interpret what we've said. So regardless of whether it's coming from us, the result is coming from ChatGPT already. That's already a problem that we need to think about. The other side is actually in complex things where it's very hard to cover a whole concept. So the other place we currently have a bot is regulations. So the NZX participant rules, Australian participant rules, and the regs. And so someone like me who it is important I'm over across as many of the rules at any given time, I can go and ask and it'll give me a view. And again, it's like a very cheap opinion as a starting point, and then can go to the lawyers from there. So that's 2 places we're using it. With regards to where we're going, we're still just getting hold of that. And to be honest, probably a few conversations with Paul and the FMA, and because, if I think about large-scale technology changes, crypto's or blockchain specifically has had a lot of hype over the last 10 years. To be honest, I've never got to the point where I can understand it's a technology that's valuable, and I can argue both sides, I think, reasonably robustly. So, but my personal opinion is that, and as we know, some regulation was probably slow to the party on that, and I'm interested in how that plays out with AI, because this technology is evolving much faster. It's blindsided us much quicker than anything has for a long time with regards to how powerful it is. Anyone in this room has used GPT 3.5, which is what's really available now. Just wait till you try 4. Like, if you haven't already, it is mind-blowing. So yet to be seen, but some conversations happening with it.
So Paul, for you, how do you regulate something like ChatGPT or a large language model where, let's say, Leighton incorporates that into his business? They're not producing the output, but the output is effectively becoming advice, or people are taking it as advice.
Yeah, so I guess the first sort of overlay on all of this in terms of innovation in general is one that we have to have the right attitude to it, which is that we can't confuse not wanting poor outcomes for investors with putting a barrier in place between investors and products which might be higher risk, which might be expensive, but which are nevertheless well managed and make sense for a certain type of customer. So we can't confuse the 2. And the way that we resolve that risk is by asking lots of why questions, including about why are you incorporating AI into your business processes? What is it doing? Essentially the same sorts of questions that I framed up there. What purpose does it serve for you? What outcomes are you hoping that it will produce? What outcomes is it producing? And if there's a delta between the two, what are the controls that you have in place, including very prompt customer communication, that sort of thing. And then obviously our ability to ask any of these questions at all, and to what questions we can ask, is a consequence of what part of the regulatory framework applies to what entity.
Okay. So, Leighton, question for you. We've talked a little bit about providing access and availability, and platforms like InvestNow and Sharesies do exactly that. The question from the audience is it a moral dilemma to encourage retail investors to invest in individual companies, given they'll probably achieve better results with a diversified passive portfolio?
Yeah, firstly, you have to believe then that returns are the only reason someone invests, and this may be true for this room, but I can just guarantee it's just not. There's lots of reasons that people choose to put money into something. I get asked this question all the time, and there's no moral dilemma for me, because I started Sharesies because I didn't have access to things I wanted. That was the problem statement, right? That's why we got together and started it. So now that's not to say I don't feel an obligation to make the easiest path. There's a technology, a product rule basically with technology, right? Which is you should make the easiest path, the path of that delivers the outcome you want for the customer. So I feel a huge moral obligation to ensure that's what our product's doing. So the simplest way to use Sharesies is the way that will get you an outcome with the least amount of information. So yeah, I get asked all the time. There's one other interesting stat, well, not really a stat, but a point I think I'd like to make on. There's not a single time in Sharesies history that we've received, or that certainly that I'm not aware of, and I've seen a few messages, we get thousands a day, that says, you have lost my money. So fundamentally, people know when they arrive at Sharesies that they are taking a risk of some sort, and that they are making the decision, and that they are ultimately responsible for it on the other side. Now, and of course, there's a lot of people often with negative portfolios, but my thing preaching from the, from the, what's that saying? Someone help me with that? Preaching from the whatever tower. Yeah, that one. Is at all times, retail investors, in my view, are underestimated, and by and large, they do sensible things and get good outcomes for what their goals are.
Yeah. For me, Leighton, I know I was talking to one of my kids the other day, and he fessed up. He said, "Oh, Dad, I have to admit I've got a Sharesies account. So I wanted to invest in some shares." And I was like, that's fantastic, because, that whole path to interest in things is a good thing. So I think it's massively powerful. And, and it's also somewhat boring and disappointing when you look at decent investment where you tell people, okay, probably what you should do is just invest in a diversified growth portfolio or aggressive portfolio. And I find it interesting in the industry that then people poke borax almost at, say, your clients investing in single shares, because the industry does sell complex portfolios to people quite readily. I know in terms of my own portfolio, I own 2 diversified funds, and that's all I own. I don't have to have a complex portfolio, because, what does it achieve? I need something efficient, something that suits. So, yeah, I think that's massively valuable, that just sparking interest in the financial services sector. It's great.
I think one of the challenges for the audience here is, and I used to suffer from this every single day when I was at Russell Investments, is we create the lens of our environment on what everybody else is doing. And, in my previous role, we were managing managed funds. Our responsibility was to a very diverse group of underlying investors. With Sharesies, it's my money. If I want to go and invest it in something, it's my choice, right? So if you're a fund manager running a diversified portfolio, you have a very different view of the world than an individual investor. But I think that's where we trip up a little bit, and that as investors, we don't set our objectives very well. Even as investment professionals, it's very hard to define why you're doing it. So why am I actually investing and breaking it down? And I come back to Maya Statman's presentation before. He's talking about advice, the importance of advice, how it's not just financial, it's well-being, and it's a whole lot of other things. In my opinion, like the two guys we've got on the stage plus the regulator offer fantastic products with different objectives. You've got to know if you're an investor what those objectives are, really. So
An extension of that, Alister, is often when Leighton and I are looking at clients' portfolios, we've got no idea what their actual circumstance is and whether or not what they're doing is right or wrong.
Yeah.
So someone could have a KiwiSaver account with you that's quite concentrated because the rest of their portfolio is broadly diversified and everything else. So I think that context is also really important, and that'll be an area I can imagine engaging with the FMA on, because it sort of goes into that code of conduct and things and the sort of duty of care. But often, you don't have the whole relationship with the client. You might only have a tiny fraction of it, and it's quite hard to assess. Kiwis are notoriously good at spreading their stuff between different providers. Like I know lots of old people who are clients of multiple private banks, and it's just how they roll.
So I've got a couple of questions from the audience on a similar topic about financial advice. Firstly, do you think that your platforms, online, delivering content online, is an effective way to deliver financial advice? And as a side to that, is there a concern about the definition of what is financial advice? So maybe we'll hit the definition first.
Yeah, so concern on the definition, no. I mean, I feel like it's pretty clear. Where it gets grey sometimes is, where it's blatantly education, but so far I think we've experienced a pretty pragmatic view from the regulators with regards to that. And when I say pragmatic, I mean, look at what the outcome is you're delivering for a customer. With regards to the first one, yes, I think platforms would be an amazing place to deliver advice, and yet it's not a place that people want to see it. So one of the things I was thinking about there is the industry. Like normally when I'm challenged, which I am often, from people in the industry around the moral part or the access part or something, it seems to me to come from a defensive part, which is like our part is less to play in this future if people are more self-directed. And my opinion is like the opposite. It's like the more people who are self-directed in doing things, the more like opportunity there is in the industry to support them to better outcomes, and I think people will evolve, whether that's portfolio value or just age or maturity or the way technology goes, to wanting advice. Like I think that's where it's going to end up. High level of confidence, and we're investing towards that future. So yeah, it's like it's not something that. It's just got to be timely, right? There's no use building it and investing in it if you're going to get the 2% of people who know that it's valuable to use it when everyone else is telling you, hey, I just want some more information and to nudge me in the right direction, and as a result, you get far better outcomes. So, yeah.
Anthony?
I think back to the earlier speaker, the man you referred to earlier.
Maya.
Yeah, and he was actually, what I took out of that is that financial advice is about solving other people's life problems rather than just investment outcomes. So I think platforms are great for creating investment outcomes where you know your parameters and things. But to me, financial advice isn't about almost portfolio construction and everything. That's part of it. It's often something far more deeper and mysterious. Like, when you're dealing with someone like me, I know how to build portfolios and things. Do I need financial advice? Yeah, probably. I could certainly, because it would be different. As the speaker was talking about, it's about finding pain points and figuring out those and solving that. And that's probably one thing I'm critical of in the New Zealand market, is often I'll go and talk to people and they're all about goosing up portfolio returns. And I just sit there going, look, it's not, to me, it's not what the job is. It's about solving other stuff for people, and I'm not sure that the bot does that, because that's human interaction and dealing with it.
Yeah.
But once you know what you sort of need in an investment portfolio, platforms are fantastic.
So I'm led to believe the UK regulator's looking at behavioural nudges as a form of advice, and where you build nudges into your online platforms or your apps, that is considered active advice, and therefore the firms providing it could be subject to advice-based regulation. That isn't the case in New Zealand at the moment, I believe. Paul, is that somewhere you would consider?
So it goes to the questions that I said before, which is if you are using gamification in your approach, what role does it serve? What form does it take? What outcomes does it drive for you and for your investors? And if it's clear that there are pockets of profitability potentially within a product that are caused by nudges, which have been very successful at building engagement, but it's not clear that the capability has been built alongside it, that it actually looks like a good decision, that would be a point of query for us, for sure. But it is about what's the outcome, rather than necessarily the presence of a nudge all by itself being an issue. That would be the reason to ask a question. And again, it would depend on what part of the regulatory framework applied.
Okay. So slightly different tact for you, Leighton. You presented a chart showing the withdrawal rate of Sharesies investors through the latest market downturn. I believe that broadly reflects the experience of KiwiSaver providers, that actually switches and changes in funds have been extraordinarily low over the last sort of year while the market's been down. Is that education or is that simply fear and loss aversion?
No, it's absolutely education, because we ask people about it. So March 2020, the surveys, or the data that was coming back was people were buying a dip. That's what New Zealand believed the opportunity was there. And I use New Zealand specifically because there's that many people talking about it. Now people are seeing it through, and on the types of share club and stuff like that, or the places that they're talking together, it's like encouragement of, if you're a dollar cost averager, then you can't stop now. Like, that's a crap way to use this strategy, and that's what most people at Sharesies do, or that's the easiest path. So it's not fear. Like, people with the fear aspect, you can see it, and it's contagious. So we would see it, and we would see it in withdrawals. That's where we would see fear.
Okay. Have you got any evidence, Anthony?
No, I was going to say, look, our investors are remarkably calm in the face of volatility. It's not like the industry was 15 years ago. Like, you and I used to turn up to large, sophisticated clients with $500 million, and as soon as there'd be volatility, they'd all run screaming for the doors, despite having, good consultants and things. So, I think people are doing the right thing. They're bright, they're reading, they're learning off each other. And they're relatively calm.
So both of your organisations have recently introduced KiwiSaver, effectively taking a page out of the Australian book of self-managed sort of superannuation type structures. This is a question from the audience. Given retirement investing in particular is a long-term game, and finance professionals are not able to consistently outperform the market, I think there's data that would change that too. There's a great research report from a company called Inalytics in the UK that have access to a massive amount of institutional data across Europe that have pointed to some serious excess return structures in active management space too. So not just the conventionally quoted S&P 500 data. So it's a good research report. You can download it for free and read it. That's a aside. Anyway.
I thought it was a question.
No, it's not a question, just a point. If you're looking for active management's ability to outperform, there is data there. Okay. So to continue with the question, finance professionals can't outperform. So should we be offering products like self-selected KiwiSaver funds to individual investors, many with limited knowledge of portfolio management? So retirement investing.
Yeah, I mean, there's only one answer from me, right? We wouldn't be doing it if not. But firstly, if it doesn't work, we'll change it, right? That's the most simple thing. If people are not getting outcomes that we think will ultimately deliver them long-term retirement success, then we'll change what we're doing. Now, why are we doing it is because, you can talk about fees and returns as much as you like, but if you cock up the contribution bit at the start, it doesn't matter. And people are not engaged with contributing at the moment. So we're trying to solve that problem. I think I saw some data the other day that said 2% gap between what people are contributing right now versus what they need to actually get to retirement. One thing I can be sure of is we're probably estimating what people are going to need at retirement on the low side. I think we've got that number wrong, and for sure it's not going to be when we're actually going to need less. So like we really need to support people into financial confidence to make sure they're putting that money away. So if you look at Sharesies base, the age, all of that thing, you know, the people who come in with the millions of dollars who we have on the portfolio have no retirement stress, right? If they happen to underperform the market by 2 or 3%, you know, to be honest, it's not going to impact their lifestyle or their well-being. For those who are not contributing enough, some of them not contributing at all, or doing 3% when they really need to be doing 5 or 6%, we can materially change their potential of a good outcome for retirement by giving them something they actually want to use and giving tools alongside that to support them in good outcomes. So one of the things we did before in fact, it was whilst we were in conversations with the FMA for our exemptions, but you know, we stress tested this to the point that if you chose the absolute worst portfolio from the range of self-select options that we're going to give over the last 5 years, and if you selected the absolute best, like you were the best stock picker ever, where would you land in the scheme of KiwiSaver returns in New Zealand over that period? And if you were so unlucky that you chose the absolute worst ones, and I can't even remember what were in them, but you would have been in the fourth or fifth worst performing KiwiSaver in New Zealand over that period of time, right? You weren't even the bottom. And if you'd managed to choose the best, then you would have outperformed the best, because obviously, you know, on that side, but it was actually by a very small amount. It was small, and there was a lot of luck in there. So, like, we've done the work internally to think, look, based on the world that's available out there, do we think with the tools that we've put in place will support people in achieving better outcomes over time? And if that's not how it plays out and things change, then we'll change the product, and we've got lots of flexibility to do that.
Yeah, I always have thought, Leighton, sort of in my mind's eye, I think about two guys sitting in a country pub somewhere, one of them saying, geez, I just pulled 650 grand out of my KiwiSaver scheme. And the other guy going, what the hell, you know, I forgot to join. And I think that's a far bigger issue for the industry in the country, and really supports, you know, compulsion to me is something we need to seriously look at. Now, as an industry provider, it's not driven by financial stuff, because if 50% of people who earn 85, 90% of the money are in KiwiSaver, which they are, then KiwiSaver is sort of as big as it is and is really successful. But it's just making sure people don't miss out, which I think is what you were saying, Leighton, that, you know, getting cute around the returns probably is important for another day. But I think, yeah, it's those people who just aren't even joining or whatever that we need to get on top of.
So, as always with panels, we seem to run out of time. I certainly would like to have more time with these guys having a chat. Got a whole list of questions, as did the audience, that we haven't managed to cover. We do have coffee and a break now. I'm going to just hand over to Andrew briefly. But thank you guys for your time, your effort. Thanks for the questions for the audience too.